Welcome to the Forager 2021 Investor Roadshow. I'm Nadine Blaney from AusBiz, and I'll be your host for today's event. Now it's time to hear from Steve Johnson and senior analysts Alex Chevalev and Gaston Amoros from the Forager Australian Shares Fund.
Thanks, Nadine, and thanks, Chloe, Gareth, and Harvey for some wonderful returns over the past couple of years. That international fund's been stealing the limelight somewhat, but our Australian fund is the one that I started with back in 2009. It's a little baby of mine, and its returns are extremely important. So the recovery over the past 12 months has been something that I'm very happy about. It's important to put it into the context here of 3 and 5 year returns that are still just below the index, and we're very focused on making sure those long-term returns well above market, like our since inception return is here. But we needed to take a big step in the right direction, and we've done that over the past 12 months. At last year's Roadshow, we highlighted a number of areas in the portfolio that we needed to perform well for us. Some deep value stocks that we needed to extract that value out of, some turnarounds that we were confident were well underway with their turnaround, some dividend-paying profitable stocks where we thought that cash generation was being underappreciated by the market, and some small-cap growth stocks that we had high hopes for. Really, all 4 of those areas have contributed strongly to returns over the past 12 months. Alex, I'll bring you in here. We might start with the value resurrection category.
That's right. So we had a couple of stocks that contributed quite negatively to the FY20 results. And chief amongst these, Thorn, iSelect, and NZME. Now, during the FY21 period, both a better starting price and some progress in the businesses themselves have meant that this category has actually been a very substantial contributor in FY21 as well. Now, extracting value has been important, as you suggest, and nowhere more so than in Thorn Group.
Yes, it's a stock that we've put in an inordinate amount of time with over the past couple of years, really trying to optimize the value that came out of the company. And we've had some success over the past 12 months. Those efforts included a trip to the takeovers panel to try and stop the company issuing a number of shares to its largest shareholder at a price that we thought was unfair. This is not the outcome that we anticipated when we very first invested in Thorn, but we've been paid 8.5 cents of fully franked dividends over the past 12 months. We've been able to exit the entire investment at just north of 21 cents. So almost 30 cents per share of value here. That's a long way north of the 8 cents where it was trading just 12 months ago. And even the placement that we participated in back in 2019 at 24 cents a share. So it's been an important contributor to returns over the past 12 months. Now, the aim is obviously to buy investments that work for us over the long term, and perhaps the most pleasing part of the past year's returns is some of our long-held investments that have performed very well for the portfolio over multiple years.
Now, these 3 businesses, they've been in the portfolio for years, and in the last 12 months, there's really been an improvement both in the profitability of these businesses and in their recognition by the market as well. Now, chief amongst these, Enero, it's been in the portfolio for more than 10 years. And in the last 12 months, both profits and the share price have really got a kick along from a US ad tech business that's been absolutely on a tear. We've had Mainstream that we'll touch on a little bit later as well, that has been the subject of a bidding war. And we've also got RPM Global, which is the largest position in the fund at the moment and the most recent addition. Now, with a fresh pair of eyes, I might actually bring Gaston here to comment on RPM.
Yes, thanks, Chev. Having spent a good amount of time looking at technology names in Australia and offshore, RPM is a good example of 2 things that lead to great returns. A, it's a great business that ticks many of the boxes of what we like in software: high growth, high margins, good cash conversion. And B, timing. You bought it at a point in time when nobody was talking about the stock. So obviously you got a great entry price. To the extent that we can do more of these going forward, that is a winning combination, and you'll see it in the returns.
And Mainstream being one of our most successful investments ever in this fund. The international fund team are bragging about their Celsius investment, and rightfully so. But this one is up there with the most successful that we have made in the business. It's one that we have also been working closely with, less so about the underlying performance of the business here, but both we and the company's management team were frustrated that the progress that they were making at a business level wasn't being reflected in the share price. The logical outcome here was always a takeover by a larger player, and we'd actually done quite a bit of work around some of the big global funds administration businesses here, acquisitions that they'd done and what price they would typically pay. And when the shares were trading at 50 and 60 cents, we had an upside scenario in our case of $1.50 or $1.60 per share. We ended up with two of those global giants fighting it out for mainstream, and the final outcome here, well, the final outcome that we've seen at the moment anyway, is $2.80 per share. That's some 7 times our initial IPO investment some 5 years ago, and has been a wonderful returner for the fund.
Let's go on to some of the newer additions now to the fund during the 2021 and late 2020 year. It was really a market upheaval situation through COVID in March of 2020, and the subsequent couple of months really provided a good opportunity to pick up some very interesting stocks while these were dramatically down on prior levels. It's really been Forager's bread and butter. It's been really pleasing that we've been able to pick up so many businesses at very attractive prices. Now, the chief lever there, the reason why we're able to purchase them at such attractive prices was the uncertainty that was prevailing at the time. So, for example, in a Life 360, which owns an app for tracking the movement of your teenage kids when they first start leaving the house, well, unsurprisingly, those teenage kids were not leaving the house during COVID. Lots of uncertainty from investors about when that movement will resume. Virgin UK, a UK-based bank, well, a lot of uncertainty around the mortgage repayments there and how, if the UK economy was going to go into more difficulty, those were going to get repaid. And even more locally, Adair's Group, it's a physical retailer and an online retailer, but the physical retailing was closed. Lots of uncertainty about what that meant for the profitability of the business.
A lot of people talk about buying when everyone is panicking. It's a lot harder to do than it is to say. And I think as a fund manager, it's really important that you've got the structural alignment right to achieve that. For us, having a closed-ended vehicle in March of last year was really important. It enabled us to invest every single cent of cash we had into the market in times of distress, and you can see that turning up in the results. It's also important to have the right psychological bent, and something that's part of our DNA here at Forager is to be greedy when others are fearful, and it's paid off a lot in 2021. Alex, it's been a great year, but there was one sector in which we lost money in 2021.
That's right. It's a blemish on a pretty incredible year, but the mining services stocks really cost us in 2021. Now, usually there is a very close correlation between the health of mining companies and the health of mining services companies. And at the moment, over the last couple of months, there's been actually quite sharp diversion between the two. That diversion is big enough to drive a Caterpillar 793 truck through. It's really incredible considering the correlations over the last 5 to 10 years between these sectors. Now, the issue here for these mining services companies has been labor cost inflation. The ones we have, though, the investments that we've made in the space, they can pass on that labor cost inflation, given enough time, to their mining clients. Both McMahon and Parenti have that ability in their contracts. Meanwhile, with the mining sector doing very well, there's been a lot more new work added into the mix. So both of these companies, which total about 4% of the fund at the moment, have won 4 new contracts apiece this calendar year.
One of the other pleasing aspects of last year that might not be so obvious to people is we've been able to clean up a number of small and illiquid investments that we had made that we were having trouble exiting. In addition to Thorn, CTI, Logistics, and Matrix Composites and Engineering are no longer in the portfolio. And combined with those big takeovers that we've talked about, it's freed up a lot of the portfolio here for reinvestment. We might move on now. I'll let Alex and Gaston talk about the new ideas coming into the portfolio and what they're most optimistic about for 2022.
So really the last couple of years, we've been finding some really interesting opportunities in the enterprise software space. Now, RPM is chief amongst them. It's the largest investment in the portfolio at the moment. Very nice, sticky revenue. It's been growing quite quickly, although initially that growth was hidden somewhat by accounting changes as the business was moving more towards a subscription model rather than an upfront perpetual license sale. And in this business, we've got a management team that's very well incentivized.
Yeah, Chev, because we never get tired of talking about software and quality. Another one we like in this category is Phineas. It is in the insurance space, but has very similar characteristics to RPM. Long-term contracts, sticky revenue, high incremental margins, and a management team which owns more than half of the company. In particular for Phineas, we expect next year, 2022, to be an important year as their customers recover from the pandemic and they have more money to spend on upgrading software systems. But maybe enough of the software chat. There are also plenty of reopening, more cyclical opportunities out there, especially now that everyone is talking about the virus. What do you think?
Well, that's right. And chief amongst these in this particular fund is the travel exposure that we have. The largest of these is Tourism Holdings, an operator of recreational vehicles. Another is Experience Co. that operates skydiving and Great Barrier Reef trips. Now, of course, both of these businesses are leveraged to an amount of inbound international tourism, and that has ground to pretty much zero. However, both of these businesses should actually come out of the pandemic in a better state and more profitable than when they went in.
But what about the most recent lockdowns? How much do they affect these companies you're so excited about?
Well, a couple of months of lost revenue is, of course, unhelpful, but it's not going to change the valuation picture here too dramatically for these businesses. Both of them, having been through the pandemic, now have some very flexible operations that they can tune up and down according to the number of people that they service. And they both have balance sheets that we believe will get them through to the reopening at the end of the tunnel here.
Maybe Unibail is another one that fits in well in this category. It is the owner of the Westfield franchise in Europe and in the US. And obviously malls were severely hit by the pandemic, but Unibail has mostly premium assets in great locations. So we would expect a strong recovery as the pandemic subsides.
Now, this one, Gaston's had some balance sheet question marks over the time. So where is that at the moment?
Well, you're right. Debt used to be a major concern, and now it's becoming less of an issue as we're coming out of the pandemic and things are getting better, not worse. And second, don't forget these guys are selling assets at very good prices, and that delevers the balance sheet and is accretive to the equity.
All right, now let's talk some growing businesses here, Gaston. And chief amongst these, AMA Group, the panel beating business. Obviously, it didn't have much work during the pandemic because we had people staying at home, getting into fewer accidents, which meant fewer cars for them to fix. Immediately after that, you had a new management team that came into the business and immediately started facing some issues around the inflation of labor cost and the inflation of parts costs as well. Now, the business remains a pretty key player in this panel beating space. It provides a service to the insurers that they're hard pressed to get at the same price elsewhere. And after reopening, we think it trades at less than a 10 times PE multiple.
Okay, so I get it that it's cheap. Is there more to your thesis here other than pure valuation?
So two things. Primarily, when we actually do reopen, we're going to be able to grow this business by acquisitions, folding more panel beating shops under the AMA umbrella and benefiting from the scale advantages that creates. Secondarily, we're going to also be in a position as this labor cost inflation subsides, where investors are rapidly looking forward to that future.
Maybe moving on to the next category of steady performers. In here, we like things like Downer, especially now that it's a much simpler business after selling its capital-intensive, highly volatile segments. The new Downer is much more focused on steady, low-capital businesses like maintaining roads and utility networks, very often for government clients, which are obviously much lower risk. And we don't think this more nuanced aspect of Downer is properly priced in by the market.
So you talk about pricing, Gaston. What are we actually paying for this new downer?
Look, it is cheap, and we think it is too cheap for what it is. To give you a sense, it is currently trading on 13 times earnings versus the market on 22 times. So that is a decent upside as they deliver on the new strategy. But perhaps that's enough on new ideas for 2022, and I'll hand it over now to Steve.
Thanks, guys, and special thanks to you, Alex, for really digging in over the past few years. We've got this portfolio in the position that we want it to be in and back delivering the returns that we know it should be delivering over long periods of time. I hope that's given you an insight into some of the investments in the portfolio today, but perhaps more importantly than that, shows the progress that has been made over the past few years. I talked right at the start of today's webinar about people, process, and opportunity. And hopefully you can see that this Australian Shares Fund is set up well on all of those fronts now. Not only do we have a collection of businesses that are performing as we want them to perform and heading in the right direction, but there's plenty of cash or soon to be cash in the portfolio to deploy into new ideas or take advantage of any market pullback if there is one. And with that, I'll hand back to Nadine.
We will get to your questions in a moment, but Steve, I'd like to ask you a few questions first. Steve, your Forager Australian Shares Fund still trades at a discount to its underlying value. Now, that is despite the performance of the past year. Why is that? And what does it actually mean for potential investors?
The whole listed fund space is a bit on the nose at the moment. It's gone from a darling sector to one which is fairly common for these vehicles to trade at discounts to NTA. And historically, that has been something that has come and gone in waves, the popularity of the space. So I think that's point number one. For us, we've compounded that with some performance issues that the past 12 months has been really good, but the 2 years before that weren't. And I think that has caused our vehicle to trade at a discount in line with the rest of the market. And that's not something that we want to see over time. The key solution for us is just to keep delivering good performance, number one. It's been 12 months of great performance. That needs to become 3 years and 5 years of good performance. And that long-term track record that we have here needs to be maintained relative to the wider market. And I think a really important thing with this vehicle is it is a trust rather than a listed investment company. And that means we pay out those returns to investors over time as we realize the underlying investments. If you look back at the history here, periods of good performance have ultimately been followed by big distributions from the fund, and that won't be any different in the future. For example, we've talked about Mainstream today. It's been a very big returner for the fund. If that takeover goes through in October, that will be realized profits that gets distributed out to investors at the end of the year. And I think ultimately that combination of returns and distributions should be something that's highly appealing to people. And we'll probably look back at this period. If we can deliver on those returns, especially, you'll look back on this period as a wonderful opportunity to buy a high-performing fund at a discount to its underlying value.
Steve, the team have just talked us through some great results. Both funds have outperformed their benchmarks by more than 3% over decently long periods of time. What makes Forager different to the other actively managed funds in the market?
I think there are three key differences, and hopefully you've got a feel for them as we've gone through today's presentation. One of them is just philosophical. I think our ability to move the right way in these dysfunctional markets and to be aggressive when everyone else is panicking is a fundamental difference that you get with Forager compared to other people. I think to execute on that, staying small and nimble is really important as well. Size is a real killer in the funds management industry. And if we want to get out there and invest in these distressed markets, staying small has been really important. I think it's a bit like having a baby. You know, it's something that you can say no 1,000 times to, and you say yes once and you're stuck with it for the rest of your life. So for us, being disciplined here around how much money we're willing to take on is super important. And then finally, I think our relationship with our clients is probably the most unique thing about our business. I had 6 or 7 people call me when the market was hitting its lows in March of 2020. First, Steve, are you okay? Now, that personal relationship has been really important. They were worried about us as people more than their money to start with. But then secondly, just reinforcing the philosophy that this is your time to shine and make sure you're out there investing our money. I think that's really unique in this industry, and we've worked hard to try and attract the right sorts of clients. And I think we've seen over the past couple of years that client behavior has really helped us achieve the returns that we've achieved.
Steve, markets are at or very near to all-time highs. What do you say to investors that are looking to invest right now?
Look, I think there's still plenty of sensible things to be doing out there, and hopefully you've seen that today. Obviously, we're not going to see the types of returns that we've seen over the past 12 months again, but relative to the interest rates that people are earning in banks, and I think relative to a lot of other asset classes out there, I still look at the equities landscape and say there's plenty of sensible things for us to be doing with your money. And secondly, to the extent that we do get a market pullback, you've seen over the past 12 months that is really our time to shine. It's almost impossible to time these things. So I think getting your money invested in the market is really important. And even if we do have a significant pullback at some point in future, that's something you should get quite excited about as a Forager client.
And as we've been discussing, value investing had a great turnaround last year. Do you see this continuing into this current financial year?
Look, I think it is set up for a further continuation of that across the resources space and the banking space. I still think these businesses are relatively attractively priced. So I don't see any reason why it can't continue over the coming years. And particularly, I think with a strong economy, we haven't really had that since 2009. It's been this spluttering recovery from the global financial crisis. And I think inflation being a big risk, but we've finally got fiscal policy and monetary policy pushing together all around the world. So I think that environment is probably pretty positive for those traditional value stocks. Again, hopefully you've seen today at our size, we don't need to be stuck in any one particular part of the market. We are flexible. We do invest across a range of different stocks. And I think you should look back over a 20-year period and say, I expect Forager to perform whether those big value stocks are doing well or whether they're not. It's our job to get out there and invest your money in the most attractive parts of the market, be that traditional value or traditional growth.